Good morning, everyone, and welcome. If you're joining us today, you're probably wondering what Basel III Endgame really means for your cash strategy, and more importantly, what you should be doing now to prepare. Over the next 30 minutes, we'll unpack that together. So let's go ahead and get into our agenda. We're going to spend the next 30 minutes discussing Basel III, talk about the implementation timeline and reforms, the impact on banks, and what that means for Treasury teams. Then we'll get into strategies for navigating the reforms before wrapping with a quick Q&A. Please feel free to add any questions you have into the chat via the Q&A box at the bottom left of the screen. And if we can't get to your question today, we will follow up after the call. So I'll go ahead and kick us off for introductions. I'm Rachel Green. I'm a senior sales executive at Jiko. And day to day, I work with treasurers and CFOs to align their cash strategy with the right solutions. And that's exactly the perspective I want to bring into today's discussion. John Stevens, with that, why don't you share a bit about your background and the work you do at Kyriba?
Thank you so much, Rachel, and thank you to the Jiko team for having us. Really excited to talk about Basel III and the changes that are coming to the banking and economic landscape. So, as I said, John Stevens, I am a senior vice president at Kyriba. I lead our global financial institution practice, capital markets, and working capital. That means we help financial institutions with digital transformation and modernization, as well as corporates with their working capital solutions across the cash conversion cycle and everything that encompasses capital markets. Thank you again. John Patterson, you're next.
Yeah, thanks, John Stevens. And yeah, super excited to be here today. My name is John Patterson. I'm a vice president at Goldman Sachs. I sit on our capital analysis and planning team. I lead our derivatives calculation team, and we're essentially in charge of calculating the risk-weighted assets, supplemental leverage, GSIB surcharge, and CCAR forecasting for the firm. So that's both across listed and OTC derivatives. So get a chance to see the full scope, and really excited to talk about Basel III. It's something that we're living in every day. So excited to get a chance to share some more.
Excellent. Thanks to both Johns. It's great for our audience to hear the expertise that you both bring into today's conversation. So with that said, let's go ahead and set the stage. Basel III traces back to the 2008 financial crisis, when regulators realized that banks didn't have enough capital, liquidity, or consistency in their risk models. Between 2010 and 2017, the Basel Committee introduced a set of reforms to address those weaknesses. And in 2017, we saw the final package, often called Basel III Endgame. So with that said, John Patterson, can you walk us through what Basel III was designed to fix and how those final reforms came together?
Yeah, happy to. And I think starting back in 2008 is definitely the right place. You kind of think about the timeline between then and now, when we originally got the notice of proposed rulemaking, or the NPR, which was a notification to all the banks around Basel III Endgame, or B3 as people like to call it. And within that period, we've seen capital strengthen across the board. I think we have quoted close to 2 times as much capital that banks are holding. And so, I think really what B3 is trying to do is the same thing that Basel III was trying to do. You want to make sure that banks are adequately capitalized and limit systemic risk. And, as product offerings change and as the banking landscape changes, you want to make sure that you are accurately capturing the different risks that come with new products and changes in the market. And so, I think some of the bullets here do a great job of summarizing. The first one here is standardized risk measures, which is meant to reduce inconsistency. And I think this is something that we'll see is incredibly important for some of the European banks as well, which are bound by their advanced model. In the US, we'll see that we have 2 regimes, the standardized and advanced regime. And you think about the standardized regime being, the same across every bank. So you would treat a corporate client the exact same, depository institution the exact same, versus in your advanced model, you're actually allowed to make internal, credit risk opinions on the different clients that you have, which will ultimately allow you to hold, in most cases, less capital or more capital, depending on the risk of that client. The next one here, the output floor, is a big one, because if you think about your advanced approach as generally across the board being more risk sensitive or kind of lower risk as you have higher credit rating clients, you no longer can, hold less capital on those. You're going to have an output floor that's going to be held in line with your standardized approach. And so across the board, that'll increase capital. And then the last one, when you kind of look at the entire package, it's really stricter capital buffers ultimately to improve shock absorption. And I think this is, one of the things that John Stevens will touch on and is an important point, which is, balancing safety and soundness in the, financial markets as well as economic growth. And so that's one of the things that B3 is meant to do.
Yeah, that's a fantastic summary, John. What I'm hearing you say is more consistent risk measurement, stronger capital buffers, and curbs on overly optimistic modeling. So it's a really great takeaway for our audience because it highlights why B3 is such a fundamental shift. So let's go ahead and move on to talk about the implementation delays. So we know the U.S. has targeted July 2025 for implementation with a 3-year phase-in, but there have been significant delays. John Stevens, what's behind these delays and how does adoption differ between the U.S. and Europe?
Yeah, thanks, Rachel. And that is a great segue. So I think, if I could summarize it in a sentence, I would say that in the US, the delays are about calibration. We see a much more mature landscape in Europe in terms of the adoption of B3 and, the rollout and associated capital impacts. So really, regulators want to make sure that B3 achieves resilience, obviously in the US, without choking off credit to the real economy. And that's where you're seeing large banks frankly lobbying against the proposed rules. So while there's a political element to it, they're also pushing back on the operational complexity and capital impacts. So we've seen the timeline move to the right and stretch while those details get ironed out and core large financial institutions as well as regionals and super regionals get comfortable with the new requirements. I think, just to set us up for the rest of our conversation, that doesn't mean that we're seeing Treasury teams stand still. So CREBA supports 3,500 corporates of all sizes across the US and Europe. And we're seeing the implementation delays being used by leading Treasury teams really to sharpen their visibility and optionality as we enter into the new B3 landscape. So that means diversifying funding sources, segmenting deposits between operational and non-operational, and making sure they demonstrate resilience to their banks ahead of the full rollout and maturation of the rules. So in other words, I would view the delay as a gift of time, but not as a kind of deferral. That the new rules are coming, the smartest treasurers are using it to prepare so they're not caught flat-footed when B3 does go live.
Awesome, John. That's a great caution. It's not a delay, but it's a deferral. And really, it's a great point for our listeners who are thinking about how to be proactive as opposed to reactive when B3 does go live. So let's go ahead and talk about what Basel III means for banks. One of the big storylines is how Basel III reshapes deposit economics. Non-operational deposits in particular face higher capital requirements. John Patterson, can you unpack what Basel III really means for banks?
Yeah. I think, one place I want to start is, I want to highlight that the way the NPR was originally written, the answer to this question across the board would be different. I think the short answer would just be B3 leads to increased amount of capital, end of sentence. And so as a part of, the relationship between banks and the Fed and Basel, just trying to understand what is the best landing place. There's been a lot of advocacy work being done to help reform the rule to find a good landing spot across the board. And, I think some of the highlights on this page speak to that. The first bucket talks about higher risk weighting. And, I would say that there are definitely some winners and losers when it comes to risk weights. You'll see that corporates, specifically investment grade corporates, are a winner. With overall benefits for risk weight treatments, which is, is good for everyone. I think I'll use an example that in the derivative space we talk about often. You have a client that is coming to the bank in order to hedge their own commercial risk. So let's say you have an airline that's coming to hedge fuel costs, or you have a client that's coming to hedge interest rate risk. This is activity that is beneficial to the company, and it's also beneficial to the larger financial landscape. And ultimately, in a lot of cases, it's going to lead to, better prices for customers. As fuel prices increase, everyone knows the holiday times, but when fuel prices increase, you also see increases in prices for tickets. And so, you think about the relationship between those two, that's really banks that are offering these different opportunities for clients to hedge their own risk. And as we see more beneficial risk weighting, you would see more beneficial prices, and ultimately, it further encourages that activity. I think some of the places you hit on non-operational deposits, there are definitely some examples where there are losers. I think depository institutions is one. And so when you talk about non-operational deposits and increased risk weighting associated with that, again, to increase safety and soundness, I think that's something that makes sense. And when we kind of look across the board, the second bullet talks about enhanced capital buffers. And, this is a change that is kind of taken everywhere. So we talk about credit risk, market risk, operational risk. Those are some of the buckets within RWA. And one of the big ones is just the addition of operational risk. Historically, operational risk was only held in the advanced regime. And what operational risk is capital that you hold to the side based on historical legal losses. So they'll take an average of losses that the firm has over a period, and you fully capitalize for that. Adding that to your final standardized regime is a pretty significant change. And so that's something that folks will continue to think about. And, again, we go back to the example that we just talked about. As we increase capital buffers, you would expect that, the prices that are associated with those offerings that banks have to clients would also increase. And so that's another one that, again, you want to make sure that that Basel III Endgame is something that is good for the financial market as a whole, and is also good for clients and customers. And the last one, talking about the output floor, again, we hit on this a bit earlier, setting a lower bound on capital, something that's going to be extremely impactful for the European banks and banks with large trading, lending, and securitization portfolios. Ultimately, you just expect that this is going to be a pretty dramatic increase on the capital that they need to hold. And so, as you're preparing, you're kind of thinking about how that interacts with the earnings that a specific business has or the overall landscape. This is a really important point for low margin clients or clients that you have favorable terms with.
Right. It's really great to dig into what that impact looks like for banks even further. So I appreciate that response, John. B3 also changes the dynamic significantly for treasurers. So let's dig into what that looks like day to day. John Stevens, we just talked about the impact of banks. How do you see this playing out for treasury teams?
Yeah, thanks, Rachel. And I think it's it is the other side of the same coin to a lot of what we heard from John at Goldman, right? So I think there's a lot of different facets of this, but what I'll start with, without just reading the slide, is to say that external ratings matter more, right? So you heard this from John. You'll hear a lot about investment grade advantage. That's just kind of the reality of B3. But it doesn't mean if you're a sub-investment grade corporate that you're just going to be caught flat-footed, right? I think we talked about implementation delays a little bit already. So I think as in this 3-year period where we see B3 continue to mature and the new rules take hold, there's also an opportunity. So just back to the beginning, again, to reiterate, external ratings matter more. B3 elevates the role of ratings as a gating factor for capital allocation for banks. Even a single notch difference can materially change your access to pricing, which isn't necessarily anything new, but we'll just see that be maybe amplified in the new environment. So we're advising corporates to treat the ratings process as a strategic engagement, making sure Treasury is actively preparing the credit story, highlighting liquidity strength, and aligning internal communications with rating agencies and banks, even more so than in the past, and especially if it hasn't been kind of a core part of the motion as you prepare for the more mature B3 landscape. So I said it again, or I said it already, I'll say it again. There's an inherent investment grade advantage here. So it's going to widen the gap between IG and non-IG corporates in terms of capital allocation. Banks have a finite balance sheet that will continue in B3 and be, again, even more amplified. And they're going to put it where the capital cost is lowest. That's the reality. That means investment grade treasurers will see preferential access, better pricing, and greater product optionality. And what we're already seeing across our portfolio is a bifurcation. So the stronger credits are being courted more aggressively, while the others are sometimes being repriced. We'll talk a little bit more about strategies heading into the rest of the webinar, but that means there's an opportunity to look at, for example, off-balance sheet liquidity where possible, and looking at other instruments that might be available to you if you are non-investment grade credit. So continuing on, touched on secured debts, prioritizing return on equity. We'll see leverage entities face intensified scrutiny, right? I think this is all kind of a tree off of, again, ratings matter more. So leverage corporates will just come under the microscope. We'll see banks be under pressure to justify exposure in front of regulators and shareholders. For treasurers, this means your liquidity story has got to be bulletproof. So again, preparing that external story, internal communications to prepare the external story. What is that front-facing presentation? So consistent cash visibility, robust forecasting, and a clear deleveraging or risk mitigation plan where that exists in the business. So transparency is not optional. We'll see it being table stakes and the ticket to remaining in the conversation relative to liquidity and product optionality. Again, I think I've touched on most of these bullets at this point, Rachel. You'll see a tactical implementation rollout over the preceding years. It's just time to be well prepared and act.
Yeah. Thank you for that, John. It's really, really interesting to learn about the impact of treasurers. I think now let's go ahead and transition to talk about the solutions. What are the steps treasurers can take now to navigate B3?
Yeah, absolutely. So just tying back into a little bit of the actioning from the impacts on the last slide. So it makes the balance sheet a scarcer and more expensive commodity. I've said that in a different way before, but I'm saying it again because I think that's really the punchline for me as we support our portfolio of corporates globally, but especially in Europe, where it's already taking hold, and now in the US, where we're going to see it roll out. So I think if I can summarize all of this, the treasurer who wins in this environment are those who can clearly demonstrate creditworthiness, diversify liquidity options, and leverage technology to engage banks as a strategic partner, right? So deep connectivity and surface area across their chosen banking partners, right? And really understanding what their expectations are. So we'll go through a little bit of the abbreviated playbook that we're including in this webinar. So first and foremost, again, almost ad nauseum at this point, is to secure credit ratings. The premium is being raised. So being proactive, transparent, and defensible. Even an indicative rating or outlook can make a huge difference in how banks allocate scarce balance sheet, especially as they adjust to the new rules. Diversifying funding sources. So we see corporates building playbooks that don't just rely on the revolver, right? So going beyond that revolver for liquidity. Looking at working capital solutions, right? So if they have obligors who are extremely creditworthy or large, looking at things like supply chain finance or receivables finance to bring some liquidity in that, again, isn't attached to just kind of the boilerplate revolver. If you have access to, commercial paper programs, private placements, I touched on receivables finance, receivable securitization, whether it's fintech-led, or bank-led, if that's the way they choose to go, we think that's an important contingency at a minimum if it's not already in place. So strengthening guarantees, right? So in higher risk profiles, guarantees and collateralized structures are coming back into focus. We've seen this in Europe, and we think we'll see it in the US as well. Treasurers should evaluate where secured borrowing gives them a cost of funds advantage against unsecured, and again, diversify the borrowing base. Upgrading financial systems, I think this is sometimes viewed as one of those, less attractive options, right? Or option, but it's critical, right? So this is one of the clearest trends we see across our corporate portfolio. Teams upgrading treasury and risk platforms to model liquidity scenarios and go further out from today, right? To give confidence to their banking and financial institution partners, track deposit classifications, and present clean data to their banks. We think this is really critical to be in the capital allocation conversation, or at least best positioned in the capital allocation conversation going forward. The more transparency you can give, the better you can defend your access. And then, collaborating with your banking partners, I think this should probably be maybe even higher on the list. This is certainly not the moment to be transactional with banks. Relationships matter. Treasurers need to articulate their full wallet value, deposits, FX, trade, derivatives, John, and understand how the relationship is scored internally by their banks under B3 constraints. Very, very important as the banks go to committee and reevaluate their books. And finally, exploring alternative instruments for deposits. Non-operational deposits are becoming less attractive for banks under the new rules. Treasurers are exploring alternatives like money market funds, separately managed accounts, and sweep structures that maintain liquidity while easing bank balance sheet strain. I think in summary, Rachel, those are some, or at least 6 high-level strategies, all wrapped in bank relationships, collaboration with their partners, and securing credit ratings and general performance.
Thank you, John. That was hugely important for our listeners. I love specifically what you said about exploring alternative instruments, especially off-balance sheet solutions. One of the biggest challenges that B3 does introduce is that banks will have to hold more capital against certain type of deposits. And that means treasurers may see banks becoming more selective about which balances they want or offering lower yields. At Jiko, we have built a different model for really this purpose, where every dollar that's deposited is automatically swept into U.S. Treasury bills that are held directly in the customer's name. That gives you the functionality and liquidity of a bank account for handling high transaction volumes, but without the capital restrictions that B3 imposes on traditional banks. It's really a way to preserve liquidity, earn competitive yield, and stay insulated from balance sheet constraints. So that's my quick plug on Jiko before I move on to the key takeaways here. So in summary, the 4 takeaways to kind of recap is: 1, the U.S. implementation timeline is still uncertain. Number 2, the proposed reforms would materially increase capital requirements for large banks. 3, Treasury teams should expect changes to deposit pricing and availability as a result. And 4, now is really the time for treasurers to start preparing strategies to navigate these reforms. So with that said, let's pause here for some quick questions. John Stevens, this question's coming to you. What's the result of implementation that's begun overseas while the U.S. has lagged? Is more money coming to U.S. banks right now since they can be more competitive?
Yeah, that's a great question, Rachel, and thank you. So I would say on paper, U.S. banks do look more competitive right now because they aren't carrying the same capital changes as Europe, but quite bluntly, at least in our view. So you do see some opportunistic inflows. But what I would say is that the reality is this is a temporary kind of advantage. The U.S. rules will kick in. As I said before, it's kind of a reprieve, a delay. The rules will kick in and the playing fields will level fairly quickly. So you don't want to be caught kind of flat-footed by shifting bank economics, internal rules, committees, et cetera, just depending on how your preferred partners are structured. So the practical move we're seeing across our client base is to use the window to lock in favorable terms where it makes sense, right? Diversify funding sources so you're not overexposed to any single bank jurisdiction, and stress test your borrowing costs under B3 assumptions. That way you're not just chasing kind of an arbitrage. Obviously where it makes sense and where you can lock term in, fantastic, but otherwise, prepare for the world that we know is coming.
I love that. Okay, and then to John Patterson, is there an expected timeline for decisions around B3 in the U.S. that you can share with us?
Yeah, thanks for the question. The short answer is no. But one thing I would say is banks are planning. There's a lot of advocacy work that's going on right now. really to help define and shape the way the final rule, is presented and lands. And ultimately, that comes with providing data and really just being very clear and communicating on what the final impacts would be based on different scenarios. If I had to pretend and throw a date, I would say, 2026 seems likely. But for right now, there's no strong indication on when specifically it'll come up.
Yeah, no set crystal ball there, but I appreciate the prediction. So let's go ahead and close out. I think we're just right at time. So thank you so much to both John Stevens and John Patterson, and thank you to everyone who joined us today. As a quick follow-up, you will receive the recording and slides by email. If you would like to continue the conversation, please connect with us on LinkedIn or click Get in Touch to schedule a follow-up. And really, in summary, if there's one thing I think we can all take away, it's that preparation is everything. Basel III will reshape the banking landscape, and the treasurers who act early, secure ratings, diversify funding, and leverage tools like off-balance sheet solutions will be best positioned to thrive. So thanks, everyone, for the time, and enjoy the rest of your day.